The European Union has long been recognized as a hub for investment, innovation, and opportunity. However, recent tax reforms across member states are signaling a significant shift in the region's economic approach. These new laws, ranging from wealth taxes to levies on unrealized gains, are poised to impact not only investors but everyday citizens as well. In this overview, we'll take a closer look at what's driving these changes and what they could mean for the future of Europe's economy. Europe is facing a unique set of financial challenges that are prompting governments to rethink how they collect taxes. With an aging population, rising public debt, and the need to fund social programs, traditional sources of revenue are no longer enough. As a result, the EU and its member states are turning their attention to wealth and asset taxation, targeting not just income, but also accumulated savings and investments. This shift is driven by the search for new revenue streams in a landscape where economic growth is slowing and fiscal pressures are mounting. The move toward more aggressive taxation reflects a broader strategy to ensure financial stability, even as it raises concerns about investment and capital flight. Imagine you buy a vintage Porsche for €80,000 and park it in your garage. A year later, collectors are willing to pay €120,000 for a car like yours, even though you haven't sold it or pocketed any profit. Under a tax on unrealized gains, the government treats that €40,000 increase in value as taxable income, sending you a bill for thousands of euros. If you don't have the cash to pay, you might be forced to sell the car, only to find the market has dropped and buyers now offer less than what you originally paid. In this way, taxing paper gains can put real financial pressure on ordinary people, sometimes making them sell assets at a loss just to cover their tax obligations. The Netherlands is introducing a major shift in its tax system with the Actual Return in Box 3 Act. Starting in 2028, Dutch investors will be taxed not only on income they've received, but also on paper gains, meaning increases in the value of assets like stocks, bonds, ETFs, and cryptocurrencies, even if they haven't been sold. The tax rate is set at a flat 36%, and while real estate and startup shares are exempt until they're sold, most other investments are included. This reform aims to address previous legal challenges but has sparked debate, as it could force some investors to sell assets just to cover their tax bills. Ultimately, the Box 3 reform represents a bold experiment in wealth taxation that could set a precedent for other European countries. For a long time, Dutch savers faced taxes on returns the government simply assumed they were earning, regardless of what actually landed in their accounts. This approach was eventually challenged and struck down by the Supreme Court, which found it unfair to tax income that didn't really exist. In response, the Dutch government introduced a new system that taxes actual returns, including gains that haven't even been realized yet. The goal is to address budget shortfalls, but it means investors could now owe taxes on paper profits, even if they haven't sold their assets or seen any cash in hand. Taxing unrealized gains means investors might owe taxes on profits they haven't actually received, which can create serious cash flow problems. For example, if the value of an asset rises on paper but the investor hasn't sold it, they still need to find cash to pay the tax bill. This situation can force people to sell their investments, sometimes at a loss, just to cover their tax obligations. Critics argue that this approach is unfair and could destabilize markets, especially during downturns. In response, some governments are considering amendments to address these liquidity concerns and make the system more balanced. In the Dutch unrealized gains tax system, not all assets are treated the same. Real estate and startup shares are notable exceptions. They aren't taxed on their paper gains each year. Instead, taxes are only due when these assets are actually sold and profits are realized. This carve-out aims to address the unique challenges of valuing and liquidating such assets, which are often illiquid and can fluctuate significantly in value. By taxing only at the point of sale, the system seeks to avoid forcing owners to sell property or startup equity just to cover a tax bill on gains they haven't yet received. As tax rates climb across Europe, investors face a tough choice: stay and pay, or move their assets elsewhere. This phenomenon, known as capital flight, sees individuals and businesses seeking out countries with more favorable tax regimes. Crypto holders and entrepreneurs are particularly sensitive to these changes, often relocating to places where their investments are taxed less heavily. The result is a shifting landscape, where countries risk losing valuable capital and talent if their tax policies become too burdensome. It's a delicate balance for governments trying to raise revenue without driving away the very people who fuel economic growth. Spain's Solidarity Wealth Tax was first introduced as a temporary response to the pandemic, targeting individuals with net assets over 3 million euros. However, what started as a short-term measure soon became a permanent fixture in the Spanish tax system, with the threshold lowered to 700,000 euros in some regions. This shift prompted many high earners to reconsider their tax residency, with some relocating to more favorable environments like Andorra or Portugal. The broader economy felt the effects as well, as the outflow of wealthy individuals led to concerns about a shrinking tax base and potential impacts on investment. Spain's experience highlights how emergency tax policies can quickly become long-term strategies, reshaping both fiscal policy and economic behavior. France has developed a multi-layered approach to wealth taxation, combining capital gains taxes, social charges, and annual real estate levies. High earners can face effective tax rates approaching nearly half of their gains, especially when social contributions are added on top of standard taxes. Meanwhile, Germany has focused on tightening inheritance tax rules, closing loopholes that previously allowed families to transfer wealth across generations with minimal tax. Authorities are also increasing scrutiny on cross-border asset transfers, making it harder to move wealth discreetly. Together, these measures reflect a broader trend in Europe toward more comprehensive and closely monitored taxation of private assets. Denmark is at the center of a heated discussion over a proposed 5% tax on individual fortunes exceeding 2.3 million euros. Supporters argue that this measure could help address wealth inequality and fund important public initiatives. However, critics warn that such a tax might discourage investment and prompt wealthy individuals to move their assets abroad. The debate highlights the delicate balance governments face between raising revenue and maintaining a competitive economic environment. As the conversation unfolds, many are watching to see how Denmark's decision could influence broader European tax policy. Across the European Union, policymakers are keeping a close eye on the Netherlands as it rolls out its new approach to taxing unrealized capital gains. The Dutch experiment is seen as a potential blueprint for other countries facing similar fiscal pressures. If the Netherlands manages to implement this system without triggering significant capital flight or public backlash, it could pave the way for similar tax reforms elsewhere in Europe. This moment marks a critical test case, as governments weigh the balance between raising revenue and maintaining a competitive investment environment. In recent years, energy and environmental taxes have surged across Europe, with CO2-related levies tripling since 2017. These taxes are no longer just a concern for large corporations. They directly affect households and small businesses as well. Whether it's higher electricity bills or increased fuel costs, these charges are now woven into everyday expenses. As the EU pushes forward with ambitious climate policies, the financial burden of these taxes is expected to keep rising. This shift means that environmental taxation is becoming a central part of the economic landscape, touching nearly every aspect of daily life. Energy and transport taxes in the European Union have a significant impact on households, often making daily expenses like heating, electricity, and commuting noticeably more costly. While these taxes are frequently presented as measures targeting corporate polluters, the reality is that families end up shouldering a large portion of the financial burden. In fact, households pay the majority of energy and transport-related taxes, which constrain budgets, especially for those with limited means. This shift in tax responsibility means that, rather than large companies absorbing the costs, ordinary people are the ones most affected by these policies. The European Union is taking steps toward regulatory harmonization by proposing a common corporate tax base. This initiative is designed to level the playing field across member states, effectively ending the practice of tax competition where countries offer lower rates to attract businesses. By standardizing how corporate taxes are calculated, the EU aims to create a more unified and transparent system. Supporters argue this could prevent a race to the bottom in tax rates, while critics worry it may reduce national flexibility and competitiveness. Ultimately, this move reflects the EU's broader push for fiscal integration and coordinated economic policy. Europe is facing a significant demographic shift as the number of retirees grows while the working-age population shrinks. This means fewer people are contributing taxes to support public services like pensions and healthcare, even as demand for these services increases. At the same time, many EU countries are grappling with rising levels of sovereign debt, which adds pressure to national budgets. To address these challenges, governments are searching for new ways to generate revenue, often turning to wealth and asset-based taxes. These measures reflect the urgent need to balance shrinking tax bases with growing financial obligations. Inflation quietly chips away at the value of your savings, making everyday goods and services more expensive over time. While this means your money doesn't go as far as it used to, governments actually benefit from this process. As wages and prices rise in nominal terms, more people are pushed into higher tax brackets, even if their real purchasing power hasn't increased. This phenomenon, often called bracket creep, results in higher tax revenues without any new legislation. In effect, it's a silent tax that gradually takes a bigger share from taxpayers, all while their standard of living may be slipping. Governments across Europe are facing tough fiscal constraints. Political realities make it nearly impossible to cut popular programs like pensions or healthcare without facing public backlash. At the same time, central banks limit how much money can be printed to avoid runaway inflation. With traditional income taxes already high and further increases risking economic slowdown or capital flight, policymakers are left with few options. As a result, taxing accumulated wealth is increasingly seen as the only practical way to generate the revenue needed to meet growing obligations. When governments raise taxes, it often slows down economic growth. With less money circulating in the economy, businesses may invest less and consumers might cut back on spending. As a result, overall tax revenues can actually decrease, despite the higher rates. This puts governments in a difficult position, sometimes leading them to increase taxes again to make up for the shortfall. Over time, this creates a cycle where higher taxes and slower growth reinforce each other, making it harder to break free from economic stagnation. Looking back at the United Kingdom in the 1970s, we find a striking example of what can happen when tax rates reach extreme levels. At that time, the UK imposed a top marginal tax rate of 98%, hoping to address economic challenges. Instead, the country experienced a significant brain drain, as talented professionals and investors sought opportunities elsewhere. Economic growth stagnated, and it took years to recover from the consequences. This episode serves as a warning for the European Union today, highlighting the risks of aggressive wealth taxation and its potential to drive away both talent and capital. Global efforts to close tax loopholes are intensifying, making it harder than ever to hide wealth abroad. Initiatives like the OECD's Base Erosion and Profit Shifting, or BEEPS, and the USFATC, law require countries to share financial information and coordinate tax enforcement. This means that traditional tax havens are losing their appeal, as authorities can now track assets across borders more easily. For individuals and companies, the era of quietly moving money offshore is quickly coming to an end. These changes mark a significant shift toward greater transparency and international cooperation in taxation. Taxing unrealized gains, as seen in the Dutch approach, is less a radical departure and more a predictable response to mounting fiscal pressures. With fewer working-age citizens and growing public debt, governments are searching for new sources of revenue. Traditional income taxes have reached their practical limits, and wealth accumulation has become the next target. The Dutch model, which taxes investment gains even before assets are sold, reflects a broader trend across Europe. As states struggle to balance budgets, such measures are increasingly viewed as necessary, if controversial, solutions. Recent statements from EU leaders reveal a notable shift in fiscal thinking. Increasingly, private savings are being discussed not just as personal assets, but as potential resources for funding public debt and economic recovery. This perspective marks a departure from traditional boundaries between individual wealth and state finances. As the EU faces mounting challenges like aging populations and rising sovereign debt, leaders are signaling that private wealth may play a larger role in supporting public budgets. This evolving approach could have significant implications for how citizens' assets are taxed and managed in the future. The European Union is taking a significant step toward transnational wealth extraction by introducing direct taxes at the EU level. These new levies target emissions, corporate profits, and financial transactions, marking a shift from relying solely on national governments for revenue collection. The aim is to fund large-scale projects like climate initiatives and recovery programs, while also addressing rising debt and demographic challenges. As these measures take hold, individuals and businesses across member states may find themselves subject to both national and EU-level taxation. This evolution reflects the EU's growing role in shaping fiscal policy and managing shared financial responsibilities. What began as emergency fiscal measures in the European Union is now evolving into a permanent system of shared borrowing and taxation. Temporary initiatives, like the joint recovery debt, are gradually being integrated into the EU's long-term financial framework. This shift means that citizens may face new taxes collected directly by EU institutions, not just their national governments. Unlike national tax policies, these EU-level decisions often involve less direct democratic input, raising questions about transparency and accountability. As a result, what was once seen as a short-term solution is becoming a defining characteristic of the EU's fiscal landscape. New EU energy directives are setting higher standards for home efficiency, which means many homeowners will need to invest in expensive upgrades like heat pumps, new windows, or solar panels. These improvements can cost tens of thousands of euros, and for many, it's not an optional expense. Compliance is mandatory if you want to rent or sell your property. As a result, a significant portion of household savings is being redirected to contractors and suppliers who carry out these upgrades. This shift effectively acts as a wealth transfer, with homeowners shouldering the financial burden to meet the EU's climate goals. For some, it's a step toward a greener future. But for others, it raises concerns about affordability and fairness. Energy and transport taxes, designed to support climate initiatives, often end up placing the heaviest burden on the middle class. While these taxes are intended to encourage greener choices, many households simply can't avoid essential expenses like heating their homes or commuting to work. In contrast, wealthier individuals usually have more flexibility to invest in energy-efficient upgrades or shift their spending to minimize tax exposure. This dynamic means that the costs of climate policy are not shared equally, raising important questions about fairness and social impact. As these taxes continue to grow, understanding who truly pays the climate bill becomes more crucial than ever. The European Union is moving toward a future where taxation isn't just managed by individual countries, but also directly by Brussels. This means that citizens could soon be paying taxes both to their national governments and to the EU itself. With new proposals for EU-wide levies on emissions, corporate profits, and financial transactions, the scope for tax collection is expanding. At the same time, traditional ways to reduce or avoid taxes are shrinking as international cooperation and regulatory harmonization close off old loopholes. For many, this signals a shift toward a system where escaping higher taxes becomes increasingly difficult, and direct democratic influence over these decisions is more limited. Given Europe's aging population, mounting sovereign debt, and limited political flexibility, the move toward wealth taxation and even taxing unrealized gains appears increasingly unavoidable. Governments are searching for new revenue sources as traditional tax bases shrink and public spending remains high. These pressures make wealth extraction not just a policy choice, but a fiscal necessity. The real uncertainty now is not whether these measures will spread, but how soon they will become the norm across the continent.